Hey stock traders, my name is Liz, and today I'm going to be sharing with you a simple strategy to make more consistent returns in your investing. So for this strategy, we're going to be using the Swing Optimizer, and the Swing Optimizer is a stock rating system. It rates stocks from 0 to 10 based on whether the price of the stock is likely to go up or over a period of 30 trading days. So the Swing Optimizer is trained to try to predict what direction the stock's price is going to move in over 30 trading days. So we're going to buy all the stocks, at least 20, with a score of 10, and then we're going to be holding them for 42 calendar days. That's 30 trading days. This is a strategy that you can make your own. You can choose certain sectors. You can run stocks through the Swing Optimizer yourself and create your own portfolio of stocks. But yeah, that's the basic strategy. So I'll meet you back at my computer. We're going to open up an Excel spreadsheet and just look at this strategy in a little more detail. Okay, so for my investment strategy, I'm going to be choosing 20 stocks from the EdgeFund top 25 stock picks. These are the most highly rated stocks from the S&P 500. Every day, the Swing Optimizer analyzes the S&P 500 stocks and chooses the best of those. So I'm going to download this spreadsheet. I can download all of these as a CSV, and then I'm going to open it up in Google Sheets. In Google Sheets, I am going to be creating a list of all the stocks that I'm going to buy. So I'll create this list on the day that I want to go and place my market orders for these stocks. Okay, so in this strategy, I'm actually just going to be doing fractional shares. So with fractional shares, you can invest an equal amount in each stock. So if you don't have very much money, I would definitely recommend doing it this way. If you have a little bit more money, you can place limit orders, and this will prevent you from some of the price gapping that can happen when you place a market order. So I'm putting a link to that spreadsheet with those calculations in the description. But let's look at how to do this as a fractional share strategy. So on this sheet, I've added my starting value for my portfolio, which is going to be $1,000. I'm investing a total of $1,000 into these 20 different stocks. So the number of stocks I'm going to be buying is 20, and this is based on the 5% rule. So I don't want to put any more than 5% into each stock. That's a good general rule to hedge some of your risk and diversify. And then the amount per stock is going to be just the starting value divided by the number of stocks, which is 50. And then once again, I'm going to be selling in 30 trading days, 42 calendar days. That's going to be on May 8th. So yeah, that's just how it works. And I just want to add a note on diversification. It's super important when you're investing if you want to get consistent returns. So this is a chart of possible outcomes over a 2-year investment period. So as you can see here in these 25 scenarios, you get a pretty consistent return. So the highest possible return is about $6,000, and the lowest possible return with buying 20 stocks is about $3,000. Now what happens if I change it and I only buy 2 stocks each investment period? As you can see, there's a much more vast range of possible outcomes. So I can make as much as $10,000 and I can make as little as under $2,000. So that's the importance of diversifying. That's it for this video. Thank you guys for watching, and happy trading.